Now, let's work on the first question, government bond versus corporate bond. Imagine this. Your client walks into your office one day and says, "I'm looking for something safe. I want to make some money, but I don't want to lose sleep worrying about it." You think about two options, a government bond and a corporate bond. The government bond is like a trusty old friend, reliable, dependable, and low risk. It doesn't give you much excitement, but it gets the job done. On the other hand, the corporate bond is more like a roller coaster ride. There's a chance for a big reward, but it comes with a thrill and maybe a scare. So what do you suggest? If you go with the government bond, you tell your client this is safe. The returns are lower, but you'll sleep peacefully. If you choose the corporate bond, you say, this could give you a better return, but be prepared for some ups and downs along the way. Now let's move on to question 2, coupon bond. Buy now or wait. Picture this. Your client is eyeing a bond with a 5% coupon rate. They sit down with you and ask, should I buy this now or wait for a bond with a better rate? Now here's the thing. Waiting for a higher coupon rate is like standing in line for a roller coaster, hoping the next ride will be even more exciting. Sure, it might happen, but there's no guarantee that something better will come along. You might be waiting forever. On the other hand, buying now is like jumping on a ride that's already pretty good. A 5% coupon rate is solid, and who knows? Waiting could mean missing out. So you smile and tell your client, it's a good time to buy. A 5% coupon rate is decent, and there's no guarantee something better is coming soon. Next up, question 3. 5-year bond or 10-year bond? Here's the story. Your client tells you they'll need their money back in 5 years. They want to invest in bonds, but they're unsure if they should go for a 5-year bond or a 10-year bond. You think about it. A 5-year bond is like a short, manageable road trip. It gets you where you need to go, and it won't keep you tied up for too long. Perfect for your client's need for liquidity in 5 years. The 10-year bond, though, is a long journey. Sure, it might offer a little more in return, but it'll lock their money away for a long time. Too long. You nod and say, go with the 5-year bond. It'll give you what you need, right when you need it. Now let's tackle question 4, BBB bond. Imagine this. Your client is thinking about a bond rated BBB. It's still considered investment grade, but it's teetering on the edge of junk status. They ask, should I invest in this? You picture BBB bonds like walking along a cliff. It's still safe, but one wrong move, and you could be in dangerous territory. It's not as safe as the higher-rated bonds, but it's not quite a junk bond either. It's a calculated risk. You smile and say, if you're comfortable with a bit of risk, this is still a safe investment, but be cautious. It's not far from falling into the riskier junk bond category. Let's move on to question 5. Interest rates rising long-term or short-term bonds. Here's the situation. Interest rates are expected to rise soon, and your client asks, should I invest in long-term bonds or short-term bonds? You picture the long-term bond like a slow-moving ship. When interest rates rise, this ship gets stuck in the water, and its value drops because it's locked into a lower interest rate for a long time. The short-term bond, though, is like a small, nimble boat. It's much better at adjusting to changes in the interest rate. So, you tell your client, go with the short-term bonds. They'll be less affected by the rising interest rates, and you won't lose as much value. Create a video using exactly this script. Now let's work on question 6. Are you ready? Your client is looking for income from bond investments. Should they prioritize bonds with a higher coupon rate or bonds with a higher yield to maturity? All right, let's get started. So, your client wants to make some money from their bond investments, right? But now they need your advice. Should they choose a bond with a higher coupon rate or one with a higher yield to maturity? Sounds tricky, but let me make it easy for you. Think of the coupon rate as the regular payments the bond gives your client, like a paycheck. A higher coupon rate means bigger, more frequent paychecks. It's like getting paid a lot of money up front. But here's the catch. Just because you're getting big payments doesn't mean you're getting the best overall deal. It's like going to a fancy restaurant. Sure, you get a big steak, but are you really getting the most value? Now, the yield to maturity is a little different. It's like looking at the big picture. Sure, you get your regular paychecks, like the coupon payments, but you also think about how much your bond will be worth when it ends. It's like getting a full meal. steak, dessert, and a nice coffee at the end. You're getting everything. So the question is, do you want the big paycheck, higher coupon now, or do you want the whole meal, yield to maturity, which includes everything? The choice is yours. Now let's work on question 7. Are you ready? Your client is concerned about inflation reducing the real value of their bond returns. Do you recommend a Treasury inflation-protected security, TIPS, or a standard Treasury bond? All right, let's talk about inflation. Yeah, the thing that makes everything more expensive over time. Your client is worried that their bonds' returns won't be worth as much because of inflation, so they need your advice. Should they buy a Treasury inflation-protected security, TIPS, or a standard Treasury bond? TIPS are special bonds that adjust for inflation. Think of TIPS like having a magical umbrella that grows bigger when it rains. When inflation rises, prices go up. Your TIPS bond adjusts and gives you more protection. It's like the umbrella growing to cover you better. Now, a standard Treasury bond is like a regular umbrella that doesn't adjust. If inflation starts to rain down hard, your regular bond won't protect you as much, and you'll feel the storm. So, while it's safe, it won't keep up with rising prices. So, what do you choose? The magic adjustable umbrella, TIPS, or the regular one that might leave you a little wet, standard Treasury bond? Now let's work on question 8. Are you ready? Your client is considering selling their bond before maturity. Should they be more concerned about the bond's current price or its yield to maturity? Now this is an important one. Your client is thinking about selling their bond before it matures. So, should they focus on the bond's current price or its yield to maturity? The current price is how much someone will pay for the bond right now. If your client sells their bond today, they'll get the current price. This is like selling your house today and getting the price it's worth today. You need to focus on the price now because that's how much cash you'll get if you sell early. On the other hand, yield to maturity is important if your client plans to hold on to the bond until the end. It's like thinking about how much total money you'll make if you wait for the bond to finish. But since your client wants to sell early, the yield to maturity is less important. So what should your client focus on? If they're selling now, focus on the current price. Now let's work on question 9. Are you ready? Your client's bond has a duration of 5 years. Interest rates have increased by 1%. How much would you expect the bond's price to change? All right, let's talk about duration and interest rates. Your client has a bond with a duration of 5 years, and now interest rates have gone up by 1%. So, how much do you think the bond's price will change? Duration is like a ruler. It measures how much a bond's price will change when interest rates go up or down. If your bond has a duration of 5 years and interest rates go up by 1%, the bond's price will drop by 5%. It's like a rule. For every 1% increase in interest rates, the bond's price will drop by the bond's duration in percentage points. So in this case, the bond's price will drop by 5%. Easy, right? Now let's work on question 10. Are you ready? The bond market is volatile and your client wants to minimize risk. Should they invest in bonds with higher or lower duration? All right, this one's all about risk. The bond market is kind of crazy right now. Things are going up and down all over the place. So your client wants to invest in something safer. Should they choose bonds with higher or lower duration? Bonds with higher duration are more sensitive to changes in interest rates. It's like riding a roller coaster. The ups and downs are bigger and scarier. When interest rates change, the bond's price changes a lot. Now, bonds with lower duration are like a gentle swing set. Sure, it moves, but not too much. The price of the bond won't be as affected by interest rate changes. So, if your client wants to minimize risk, they should go for bonds with lower duration. Keep things calm and steady.
Now, let's work on question 11. Are you ready? Your client's bond is trading at a discount. What does this mean? All right, let's get started. Your client sees a bond that's trading at a discount. Sounds like a bargain, right? But what does that really mean? Imagine you're buying something on sale, like a pair of shoes that normally cost $100 but are being sold for $80. That's exactly what's happening with this bond. It's priced lower than its face value, like a bond on sale. Why? Well, maybe it's because market interest rates went up, making this older bond less appealing. So you're paying less now to get the same future returns. Buying a bond at a discount means your client is paying less than the bond's original price. It's like grabbing a deal during a sale. Now let's work on question 12. Are you ready? The bond your client is interested in is trading at a premium. What does this indicate? Alright, now let's talk about a bond trading at a premium. Think of this as the opposite of a discount bond. Imagine you're paying more for a pair of shoes than they originally cost, maybe because they're in demand or offer something extra. In the bond world, a premium means the bond is priced higher than its face value. Why? It could be because this bond has a higher coupon rate, paying more interest than what's available in the market right now. So, people are willing to pay extra for that sweet, steady income. Your client is paying more upfront, but getting better interest payments over time. Premium bonds might seem expensive, but they're offering something that others don't. Now let's work on question 13. Are you ready? Your client wants to buy a callable bond. What's a potential risk? Okay, let's dive into callable bonds. Sounds fancy, right? But they come with a little catch. Imagine you've rented an apartment for a year, but halfway through your landlord says, "Hey, I need the place back, so you have to leave now." That's kind of what can happen with callable bonds. A callable bond means the issuer can call it back or repay it early. So your client might be counting on those interest payments for a long time, but bam! The issuer decides to pay off the bond early, and your client misses out on future interest. That's the risk. They won't get all the payments they expected. Now let's work on question 14. Are you ready? Your client has been offered a convertible bond. What's a key benefit of this bond? Let's talk about convertible bonds. They're kind of like a superhero bond with a hidden power. Here's the deal. A convertible bond is like a regular bond, but it can transform into stock in the company at a later time. Imagine your client bought a ticket to a concert, and later, they find out that ticket also gets them backstage passes. If the company's stock price goes up, your client can convert the bond into shares, potentially making more money than with just the bond's interest. Convertible bonds give your client a chance to jump into the stock market while still enjoying the safety of a bond. Now let's work on question 15. Are you ready? Your client's bond has been downgraded by the rating agency. What might happen to the bond's price? Let's think of bond ratings like grades on a report card. If your bond gets an A, people love it. But if that grade drops to a C, suddenly everyone's looking elsewhere. A bond downgrade means the rating agency believes the bond has become riskier, and guess what? People don't want to take as much risk. So what happens? The price of the bond usually drops because investors demand a better deal for holding a riskier asset. Your client's bond just got a lower grade, and the price has likely dropped as a result. Now let's work on question 16. Are you ready? Your client wants to minimize risk and preserve capital. Should they invest in investment-grade bonds or high-yield bonds? Okay, let's talk about investment-grade versus high-yield bonds. Think of investment-grade bonds as the A-plus students, super reliable, less risky, and always turning in their homework on time. High-yield bonds, though, are more like the C students. They have the potential for big rewards, but come with way more risk. If your client wants to play it safe and minimize risk, investment-grade bonds are the way to go. Sure, they might not offer huge returns, but they're way less likely to lose money. High-yield bonds? They're risky business, like betting on the long shot at a horse race. Settings: add bold subtitles with popping effect. Use bond basics as watermark text. Now let's work on question 17. Are you ready? Your client asks if the bond's price is influenced by market interest rates. What do you tell them? Absolutely. Bond prices and interest rates have a bit of a love-hate relationship. When interest rates go up, bond prices fall. It's like a seesaw. When one side goes up, the other side comes down. Why does this happen? Imagine you've got a bond paying 5%, but now new bonds are paying 6%. Suddenly, your 5% bond doesn't look as attractive, and its price drops. So yes, market interest rates have a big influence on bond prices. Now let's work on question 18. Are you ready? Your client holds a zero coupon bond. When will they receive interest payments? Zero coupon bonds. These are like the long-lost friends of the bond world. You don't see them often, but when you do, they're all about that big payoff at the end. With a zero coupon bond, your client won't get any regular interest payments, no monthly or yearly checks. Instead, all the interest is bundled up into one big payment when the bond matures. It's like getting a lump sum at the end of a long savings plan. Your client has to wait, but the payoff can be worth it. Now let's work on question 19. Are you ready? Your client's bond is about to mature. What happens? Think of a bond's maturity like reaching the finish line of a race. Once your client's bond matures, it stops paying interest, and the issuer repays the face value, like getting a prize at the end of a race. So, what happens? Your client will receive the face value of the bond, that's the amount they originally invested, back in full. The regular interest payments stop, but they'll walk away with their principal safe and sound. It's the end of the bond's journey. Now, let's work on question 20. Are you ready? Your client is worried about credit risk. Which type of bond should they avoid? If your client is worried about credit risk, basically the risk that the issuer won't pay them back, they should steer clear of junk bonds. Junk bonds are like the daredevils of the bond world, offering high returns but with a much higher chance of default. Your client should stick with investment-grade bonds, which are far less risky and more likely to pay back as promised. Junk bonds might be tempting, but they come with the real risk of losing money. Now, let's work on question 21. Are you ready? Your client is comparing two bonds, one with a 5-year duration and another with a 10-year duration. Which bond is more sensitive to interest rate changes? Alright, imagine this. You're on a seesaw. The longer your side of the seesaw, the more extreme the ups and downs, right? That's exactly how bond duration works. A 10-year duration bond is like the long side of a seesaw, more sensitive to interest rate changes, meaning it will rise or fall more dramatically. The 5-year bond is the shorter seesaw, less movement. Why is that important? If interest rates go up, the 10-year bond takes a bigger hit than the 5-year bond. The longer the duration, the greater the interest rate risk. It's like taking the bigger side of the seesaw, riskier, but with bigger swings. Now, let's work on question 22. Are you ready? Your client is considering investing in a bond mutual fund. What should they expect? Let's picture this. Your client wants to spread out their risk. Think of it as not putting all their eggs in one basket. So instead of buying just one bond, they're joining a bond buffet, a bond mutual fund. This fund pools money from many investors to buy a whole spread of bonds. It's like going to a buffet instead of just ordering one dish. You get a taste of everything, different bonds, different sectors, and even different maturities. Diversification helps reduce risk since you're not relying on just one bond. It's like having dessert, salad, and a main course. More variety, more safety.
Now let's work on question 23. Are you ready? Your client wants to know how to determine the bond's yield. What factors should they consider? Think of bond yield like figuring out how much bang you get for your buck. There are two key things to consider: the coupon payments, the regular paychecks from the bond, and the bond's price, how much it costs today. Imagine your client bought the bond at a discount. It's like getting a deal on a meal but still getting all the food. The yield will seem higher since they paid less for the same income. But if they buy it at a premium, It's like paying extra for the same dish and the yield looks lower. So they need to consider both the coupon and the price to get the real picture of their return. Now let's work on question 24. Are you ready? Your client asks if they should sell a bond before maturity. What might influence this decision? The age-old question, to sell or not to sell. If your client needs liquidity, maybe they need cash for something urgent, or if they think interest rates are going to rise, selling could be the smart move. It's like deciding whether to sell your house now or wait. If interest rates rise, the value of the bond could drop, making it worth less later. But if they don't need the money and interest rates are stable, holding the bond until maturity means guaranteed returns. It's like staying in the house and enjoying all the comforts until it's time to move out. Now let's work on question 25. Are you ready? Your client wants to invest in bonds that are less likely to default. What should they prioritize? Let's talk about safety. When it comes to avoiding defaults, credit rating is your best friend. Think of a bond's credit rating like a GPA. Higher-rated bonds, the A+ students, are more reliable and much more likely to pay back as promised. Lower-rated bonds, the C students, might offer higher returns, but they're riskier and could fail the class, aka default. So your client should prioritize bonds with high credit ratings. A high coupon might seem tempting, but if the bond's credit rating is low, it's like getting extra dessert without checking the expiration date. Risky. Now let's work on question 26. Are you ready? Your client wants to invest in bonds but is concerned about taxes. What type of bond should they consider? Let's talk taxes. If your client wants to avoid a tax headache, they should look into municipal bonds or muni bonds. These are like tax-free cupcakes. They're often exempt from federal taxes and sometimes even state taxes, depending on where your client lives. Corporate bonds, on the other hand, are fully taxable, which means your client's returns will be chipped away by Uncle Sam. So if taxes are a concern, your client should go for muni bonds. It's like enjoying a treat without worrying about the extra calories or taxes. Now let's work on question 27. Are you ready? Your client asks if bond prices are always stable. How do you respond? Nope, bond prices are not always stable. They're more like a roller coaster. Bond prices can go up or down based on market conditions, especially changes in interest rates. Here's how it works. When interest rates go up, bond prices tend to go down, and vice versa. It's like a teeter-totter. Some bonds are more affected by these swings depending on their duration. So if your client thinks bonds are a set-it-and-forget-it kind of investment, let them know bond prices can move. Just not as wild as stocks, but they're not completely still either. Now let's work on question 28. Are you ready? Your client asks what happens to bond prices if the Federal Reserve cuts interest rates. What do you tell them? Time for some Fed talk. When the Federal Reserve cuts interest rates, bond prices usually go up. Why? Think of it like this. If new bonds are offering lower interest rates, suddenly the old bonds with higher rates look like VIP tickets at a concert. Everyone wants them. Since these older bonds are offering better returns, demand for them goes up, and as demand increases, so does the price. So if the Fed cuts rates, your client's bond is likely to get a price boost. It's like your client's bond just got an upgrade to front row seats. Now let's work on question 29. Are you ready? Your client is concerned about rising interest rates. What type of bonds should they avoid? All right, here's the deal. Rising interest rates are like sharks circling in the water. They're bad news for long-term bonds. Why? Long-term bonds are like the Titanic, big and slow to react. When interest rates rise, these bonds take a big hit because their prices drop faster than a sinking ship. Think of short-term bonds like speedboats. They're nimble and can handle the waves. So if your client is worried about rising rates, tell them to avoid long-term bonds unless they want to experience the sinking feeling of falling prices. Stick to short-term for smoother sailing.